Well, hello everybody. This is Ken Winans and Stephanie Larson from Winans Investments. And as you all have commented, you love having at least our bi-weekly videos. So we thought that with all the crazy stuff going on in the world, it might be a good time to have a talk about things. We're not going to have as long a video as we did a week and a half ago because that was almost 10 minutes on things, but we did want to cue in on a couple of the points we talked about last time and things that we've done here, where we've taken the thought or theories and putting it into action. So first off, let me first talk about market volatility. This market has been very strange, to be as candid as I can be, to see the market leadership gyrating around almost on an every other day basis. My stock target list or my investment target list that I usually do once a week, I'm now updating it every 3 days. That's how much things are changing. So volatility should be a little bit of a concern to everybody. This is something that when this begins to happen, investors should just kind of take a step back, let it play itself out. We have been raising cash, as many of you have commented. We let the individual investments determine how much cash we're actually going to raise at any given moment in time. But that is because we're trying to figure out what the next steps are. What I would say is this: we've been talking a while about inflation. I know there's a long discussion going on right now with our elected officials in the government about inflation. All I will simply tell you folks is go to the grocery store and you tell me if milk and bread and eggs is cheaper today than it was a year ago. It is much more expensive. So those of us who do in fact have to go to the store will notice that. And also keep in mind that the volatility in the market is also largely tied to interest rates. Interest rates are going up. This has an effect on the stock market, on the bond market, on the real estate market, commodity markets, all of it. Last point I'm going to be bringing up, many of you have asked about the commodities that we've been adding to the portfolios. We have been adding exchange traded funds to your portfolios. They are basically baskets of commodities. As you would very well know, I prefer not to use products where I would prefer not to use them. But right now, this is the best way for us to play the commodities side. We will continue to add those because I think they will be very strong investments going through the rest of this year. So Stephanie, what would you like to cover?
Well, I think the volatility is a very important part to really hammer home with you guys. Ken and I were talking along with some other of our staff and employees that for the first time in a really long time, the market doesn't really feel like investing. It feels more like gambling. You could really just go to Vegas and toss a chip on a table and, it's 50-50. You might win something, you might not. It really feels like that. It's
very much
bizarre. And people are chasing. They're chasing the performance. They're chasing returns. Oh, this is doing great today. Let's go buy that. Or that's doing great the next day. Let's go buy that. And it's helter-skelter. And there's no leadership. And on any given day, there could be multiple 100-point swings in any position, regardless of what the general index is doing or the general market. So it's really hard to get a beat on it because I feel like there's a lot more novice investors that are in the market right now. And actually the stimulus check thing would be interesting because there was an article out the other day that was saying people the age of between 24 and I think it was 36 were going to put all of their stimulus money if they got it into the market. I feel there's this new group of investors that are pushing things a lot more than what if it was just normal institutional investors. And it's very bizarre to operate in this type of world because you would expect to have the fundamentals or the multipliers or anything. You can say that the bull investors have long stopped caring about anything that has to do with fundamentals or anything to do in any type of historical reference in that manner. It's not about the multipliers or the cash flows or the balance sheets or anything. They don't care. They're willing to invest in companies where it makes no sense simply just because that's where all the momentum is right now. And so it's making us have conviction in what we want to buy more challenging.
Exactly. I'll add to this as well. I mean, as you all know, I've been in this a very long time, and there have been periods of time of these high volatility type moves in the markets, whether you're back in the 90s with tech stocks or real estate stocks back in the 2006 and 7 range. All I would say is this: there are times that you might want to raise cash, pull back, let things sort themselves out. Yes, you might lag a bit for a period of time. We don't lag for long, but we did go into this year after having 3 really solid years of performance. I told Stephanie I did not want to start handing back those gains going into this year. And, it pains me to trim back some of the stock positions we've been trimming back, but we have a disciplined approach to raising cash. And when you have stocks, a good case in point, Amazon. Amazon has not hit a new high in 8 months. The momentum has left that stock. Clearly, there's some concerns. We've made a lot of money in it through the years. I want to trim things like that back. At the same time, to be very candid, I have a tough time selling Amazon and jumping into a restaurant or a hotel chain. I'm not 100% sure that those, or the tourism industry, I'm not sure those things are going to be coming right back online this year. I think those are more of people jumping in trying to get something really cheap, but I don't know if that's sustainable as an investment going forward. So we wanted you folks to know that, look, we're dealing with this every single day. We know the volatility can be downright scary. It can also make you a bit greedy from time to time. And all that we're asking you to do is that, look, we follow a methodology that's worked well over nearly 30 years. I'm going to maintain that discipline. And if you want any changes to your portfolio or your philosophy, my suggestion is get your first quarter results, also include what we did in 2020. Then if you want to make adjustments to your strategy, we'll have a talk then. But to try to chase things right now, what you can do is get yourself over trading. You can find yourself buying the high, selling the low, and doing that a couple of times over, and you begin to realize there's a game I played when I was a kid called Twister. And you end up playing financial twister where you suddenly look and you're all twisted up. You're going, how did I get here? You don't want to do that. There's times just to sit back, let this thing find its equilibrium, and then we'll move forward once we're comfortable.
I think, excuse me, I also think that one of the important things to really talk about, is the commodities. And so Ken and I were talking about it this morning again. Most of you guys probably don't know, I have a double degree in economics. And so we were talking about the Fed and Janet Yellen, monetary policy, interest rates, and the yield curve. The Fed and Janet Yellen are on the same page. They're going to keep the economy, the market flushed with money. They're not moving rates, they're not doing anything. But they have a limit on what they can actually control. They can affect the short-term yield curve, the short maybe slightly after that, but the tail end of the yield curve, they have no control over. That's just supply and demand, that's just normal market pressures. And so when the yields start moving and the interest rates move up, investors, that's what we saw the last week or two, is investors started to freak out and they just pumped the brakes and just said, hey, wait, hang on. I don't like that action, we're not ready for that. And the reason why they're scared is that they know that the Fed and monetary policy with Janet Yellen, there's only so much that they can actually control. So that's something that we're watching closely. What it is going to affect is inflation. And even though we don't see a demonstrable amount of inflation right now in the market, Ken and I both agree it's there, and you can see it, especially, but people aren't talking about it, not at length. But anytime that elephant gets in the room and people start talking about inflation, you see the market freak out, and it absolutely takes a dip. And I could track it over the last two and a half months. Every single time it brought up, whether it was between Jerome Powell or the talking heads on TV, the market pulls back. They don't like it. The commodity play that we're making is a great hedge against inflation, and we think it's going to be a short to mid-term play. So if you're looking at it and going, well, you just bought that and it's kind of doing this a little bit, that's not what we're looking at it for. We're looking at it for a long-term, a mid to longer-term position where it's going to protect us if this actually starts pulling back. Because what you did notice is that every time the market went down, and it didn't matter if it was the NASDAQ, the Dow, or the S&P, because they all didn't go down on the same day, our commodities went up that day. And it's going to be that inverse kind of teeter-totter move that we're looking for to balance it. And what Ken mentioned earlier was the truth. We had a great year last year. We don't want to cough it up. So we are being very conservative with how we approach the market. We sold out the names we didn't like. We've raised cash. we put in some inflation pieces, i.e. the commodities, and we're being very judicious about the names that we're trying to actually add to the portfolios as we watch for this struggle of leadership. We're not exposed to the market, we're just being very cautious about how we approach it. You know, you don't want to always hit the home run, and that's what people are doing in the market right now. They're chasing those home runs. We're looking for solid doubles, you know, constant singles and doubles, maybe a triple every once in a while. We're not looking to just, you know, hit it out of the park. We're not playing all those kind of meme stocks, the GameStops and the AMCs and everything. So we're trying to keep out of that fray, but that fray affects the rest of the market, whether intentionally or non-intentionally.
And I'll just finish on this note. A couple of things and as you all know, we look at it historically. If you were to ask me the questions, how healthy is this market? There's a term that we use called a divergence is happening. And what I mean by that is, you know, we don't mind if you take the Dow, the S&P, the NASDAQ, and they all perform differently at different times. What worries me is if you have one or two of those indices going in one direction and the other ones are going in the other direction. The last time I saw a situation like that was back in the late 90s. That is not a healthy scenario. You want basically the herd to all generally move in the same direction. Then the other part I would bring up is that, again, when you look at the length of this rally, the time it's been going on, this is historically very stretched. So when we're committing new money right now, I don't want to buy into an overpriced situation that then, oops, we go into earnings season and these stocks didn't quite meet expectations and they blow up. So again, that's why we're cautious about keeping money around, keeping our powder dry right now, getting ready for the next round of investment once we really see where it's at. Last up, a couple of quick things. We want to talk about administrative items. Look, I know a lot of you folks are losing your patience with dealings with the brokerage houses and banks and insurance companies and mortgage companies, anything in financial services. I can honestly tell you that Mindy and Amy have been on hold over an hour sometimes with Schwab and TD Ameritrade trying to get things done. And they might be something as simple as converting a minor's education account into an adult situation. It's just taking time. It is not us dragging our feet. But what we're going to ask you to do is, again, if you have a complex situation, you need to send us an email of what you want done that we can forward to the brokerage houses, because I just can't have our staff tied up for hours at a time on very minor things, especially going into tax season. So we just want you folks to understand, unfortunately, we don't see much changing in dealing with a custodian, and it's across the board, folks. It's not one firm versus the other. The simple fact is, in our industry, it works better when people work together and when you have people working from home. And I know that Amy and Mindy have called people 5 different times, or they've called the same number 5 different times. They've talked to 4 different people, and in many cases get 3 different sets of answers. So it's very trying for us as well, but we wanted you to know we understand your frustration, we understand your concern. We just want to give you an honest assessment, and there's not much we can really do about it right now. So not to leave you on a negative note, but COVID's not over. We all know it's not over. It's probably going to take the remainder of this year for things to get back to normal. So anyway, stay safe. We're doing our best to stay very safe around here. Most of us just took our COVID test. We're all negative, thank goodness. But we hope that you folks are doing well, and we wish well for your families as well. So we'll talk to you soon.
Bye, guys.